Okay, with that, it's time to bring in our next guest to get some perspective on this market. We have Nikhil Ranka, CIO Equity Alternatives at Nuvama Asset Management, joining in with some thoughts. Nikhil, morning. Great to have you with us on Money Control today.
Kenya. Thanks for inviting on the show.
So, Nikhil, earnings season. Hi. So, earnings season is in its final chapter now. The market has also rallied, reacting to numbers that have been, that have been showing fair amount of promise. So, where do you think, where are we vis-a-vis earnings and the fact that the Nifty, at a Nifty level itself, we have rallied all the way to now 24,500.
So, Surbi, if you just see the earnings for the Nifty 50 companies that have reported till now, X of OMCs, we are still looking at close to 14-15% growth, and this growth we are seeing almost after 4-5 quarters for Nifty companies, because all said and done, the base has become very favorable, especially for the banking sector now. If you see the FCNR number which got reported till 31st July, we are looking at close to 36-37 billion of inflows, which means that Q2 also will be very strong for some of the banking names. So all in all, 2-3 things if you see. One, this time around, even though there was some issues with the Strait of Hormuz, the FII flows were pretty decent. We didn't see big outflows as we saw for the first time. So incrementally, the impact of the negative news flow on crude is not leading to very big selling on the Indian markets. And the fact that we are now back to double-digit earnings growth should mean that at least for the time being, till we don't see another big negative news flow, 23,800 should be a big floor for the markets. And even the AI trade to a large extent has unwound in that sense. And therefore, my sense is India should start finding flavor back with foreign investors. And they should start adding back to the underweight stance that they have taken on India in the last 6-9 months. So that should augur well for the markets.
No, absolutely. And that's a point well taken, Nikhil. And I think the evidence is already coming in, right? I looked at the FPI flows. Finally, after 4 months of non-stop selling, we were net positive for July. $2 billion came in July. And I think that's now, it's become very clear because this whole semiconductor trade especially is not a clear one-way trade anymore. It's gotten very, very volatile. But Nikhil, the question is that, okay, so we have rallied. I'm just looking at a Nifty chart. Let's pull a 1-year Nifty chart. The market, the highest point of the rally was 24,576, which we hit in April, 21st April, when we recovered from the West Asia war. We are very close to taking out that high. So my question, Nikhil, is do earnings have enough juice to give us a real substantial breakout? Not just a trading bounce, couple of points here and there, but do you see chances of a bigger breakout on the Nifty, looking at the evidence in terms of earnings?
So Surdeep, if you see the pattern of the last 24 months, so we peaked in September 2024 at close to that 26,200 levels. And post that, we have seen single-digit earnings growth for the last 2 years. So it's not that we have degrown, we have still grown. And if you see for 27 and 28, the consensus is expecting anywhere from 12-13% growth for 27 and close to 15% growth for FY28. So in terms of valuations, clearly what used to be a 20-year, 1-year forward earnings is now close to 17 times 1-year forward earnings. And if growth comes back, my sense is you may not see big earnings upgrade per se for the Indian markets, but clearly the multiple derating that had happened for India because a lot of money shifted to countries like Taiwan, Korea, where you had those AI plays, could slowly start shifting back to India. And that is where I think the next leg up from this 24,500 levels for the Indian market should come through. Even globally, if you look at it, the traditional IT names have started seeing some leg up, from the lows. Most of those companies are also up 20-25%, with yields cooling off because of crude. Banking should start to do well. So overall, I think the headwinds for the Indian markets to a large extent have receded. And from here on, assuming that we don't get incremental negative news flows, the market should start trending up. And we have to also be cognizant of the fact that we have midterm elections in the US in the next 3-4 months. So hopefully the headline news flow also starts to get much better as we head into the midterm US elections. And that should give a lot of comfort to market participants if we don't see any incremental negative news flow from the global front.
Oh, absolutely. Take that point. I think the only incremental risk globally, Nikhil, if at all, is these high US yields, right? The US bond market is indicating something else. While the stock market continues to rally, either tech or non-tech, and I was looking at numbers from all the US oil giants, obviously like windfall gains for those companies with the way oil rallied. So US equities have been doing okay, but this US bond market is signaling something else, with yields at the highest level since the global financial crisis. What do you make of that?
So two things over there should be one, clearly the inflation scare is there because initially the expectation was for 2 rate cuts this year, but given the way crude behaved, nobody is now building in a rate cut in this year. If at all, the debate is whether we have a hike or not in that sense. And the second part is, if you look at the demand supply equation for the US bond markets, that also has moved quite unfavorably because a lot of central banks which initially used to participate in the US bond auctions have incrementally stayed away from that, and that money either has shifted to gold or some other asset classes in that sense. So it's more the US private sector which has to do the bailout now, which is causing a crowd out, and the fact that deficits are only increasing. The debt is now almost close to 40 trillion for the US government. All that is putting pressure on the US yields. So my sense is till we see a very, very clear sort of fall in crude prices back to that $65-70 and the rate hike scare starts to go away, till that point yields could continue to stay a bit elevated. And then I think there could be some cool off in yields, but structurally I think for the US markets the yields could stay higher for longer.
Okay. So, Nikhil, since overall you seem to be quite constructive and you're sounding positive on Indian equities, and if we are expecting higher levels at the index from here on, then what's the portfolio looking like? What would you add? What would you buy? What would you maybe prune, take some profits off?
Yeah, so the last time also I was there, I said, banking continues to be our favorite sector. We still feel that, from the 7.15 levels that yields hit in the month of April, May, we are now back down to 6.7. And growth impetus will very clearly come back with the FCNR deposit. So, when we started this FCNR bond raising saga, we were expecting close to $50-55 billion of inflow by September end. We have seen 36 billion of inflows by the end of July itself. So in all probabilities, we will surpass the $55 billion when we end this in September. And on a base of 300 lakh crores, that $55-60 billion incrementally will give to 2.5% fillip to the overall deposit growth, which will obviously then translate into lending growth for banking names. The second part is the worst of the NIM compression is behind for banking names. So if you have a 13-14% credit growth in banking, then pre-provisioning profit growth will be more than 15% as we head into the second half of FY27 and FY28 for banking names. And the second part is, if you see for crude sensitives, incrementally the market is not reacting in a very bad way to whatever sort of wrong headlines that we see on the US side. So if you just see the last time we went to $115 when we had closure of the Strait of Hormuz, but this time around, even though the closure was announced, we didn't go beyond 95 levels. And if we have a window of 1 or 2 months where we don't get any negative news flow, then globally everybody will start building in decent inventories. So the incremental impact of that negative news flow with subsequent time will start receding in my view. So therefore, crude sensitives, banking, these are the 2-3 sectors where aviation, OMCs, which probably will start performing very well from here onwards. IT, as I said, is more in a trading band because obviously we don't expect revenues to decline, but the growth will clearly get hampered because there will be some sort of revenue deflation because of AI taking effect. So overall, IT could be in the single-digit earnings growth trajectory, and therefore that sector could be in a trading range. But banking and crude sensitives are the two sectors which could do very well as we move forward.
Nikhil, your call on crude sensitives is a really interesting one, and I take your point here again that the market's reaction, incremental reaction to every tweet or post is not that sharp. Absolutely. And even when the missiles were flying and they were striking each other, US and Iran, oil briefly went to 100, I think for a few hours, and then it quickly slipped back. So I take your point. Now, if oil is to stabilize between this 80 to 90 zone, and if you want to play on crude sensitives, then how would you look at it? I mean, will it be the refining companies? Because refining margins are, I think, hitting all-time high levels around the world, right? So will you look at it, HPCL, BPCL type of plays? Will you look at standalone refiners? Are auto stocks still a play? I'm not sure. Rubber, tire manufacturers. How do you play the crude sensitives?
Surbhi, clearly, if you look at it, OMCs this quarter were expected to report very bad set of numbers because marketing losses were expected to be extremely high. But apart from HPCL, if you see BPC.
Uh-oh. I think we have just lost the line with Nikhil. Okay, we'll just get him back to explain that point on what he's liking in the crude sensitive trade, and we'll get back to that. Otherwise, of course, still quite positive on banks. That's Nikhil's view, and he has been quite positive about it. And for IT, he's seeing it more as a trading play. Do we have Nikhil back now? Nikhil, sorry, we lost you there. You were just explaining to us how you will play crude sensitives. What part of that basket?
So, Surya, I was just saying, if you see for OMCs, this quarter was expected to be very bad for all the top three OMC names. But BPCL and IOCL have clearly outperformed on the earnings front. And incrementally, as we move into Q2, things start getting better for both of those names. So, as a pack, OMCs should start to do well because there will be twin benefits now. You will have refining gains, as well as you will have marketing profits coming back. Aviation again is another sector which we are positive on in that sense. The only problem with standalone refineries is that there is this windfall gains, and therefore the entire extent of the earnings gain that should accrue to them, that won't come through in that sense. So OMCs, aviation, these are the two sectors where you could play on the crude sensitivity.
Okay, OMCs and aviations, got that sense. Nikhil, where are you on consumer and the read-through that we've seen in that whole consumer universe? There are stable companies where numbers, at least the volume growth numbers, are looking better than the last many quarters. Then there are the platform companies, and we've seen very different trends between an Eternal, Swiggy. Meesho did well. Today, urban companies, the stock is surging away. So clearly, markets looking at platform names. So just cut it up for us. What are you playing in consumer and how?
So on the staple side, should be clearly what is happening is given the fact that markets now don't think that there could be a double-digit earnings growth in these names because one, the volume growth is not going beyond 4-5% for most of these names. Margins are in a very tight band because for a lot of companies, advertising spends are going up in that sense. So therefore, what initially used to be a 50 PE for consumer names, for most of the names that multiple has now settled between 35 to 40 times on the staple side. So my sense is from here on, probably we may not see more PE multiple derating, and the stocks could track the earnings growth. So 8 to 12% band is what one should expect from these names going forward. On the platform companies, as you said, for the likes of Eternal per se, we saw quick commerce for the second quarter back into black. Margins also expanded to 0.7%. And the GOV growth, NOV growth of 80%, even if that sustains at closer to 60-65%, then the consensus expectation is that they will do anywhere from 6,500 to 7,000 crores EBITDA for FY28, which will translate to between 35 to 40 times EBITDA for FY28, which now is at the lower end of what Eternal has historically traded at. And the fact that, the competitive intensity in the sector is clearly coming down, because if people don't get money, the cash burn will come down, the discounts will come down. So from that perspective, it is positive for margins in the longer term for the quick commerce companies. And as more and more companies start reporting positive EBITDA on the quick commerce side, I think the sector should start to get visibility back from investors. And this consolidation phase that we had seen for the last 9 to 12 months could come to an end for those platform companies.
So, will you use a basket approach? Are you positive on all, Nikhil, or are you sticking to the leader, which would be Eternal in this case?
I think we will be more comfortable sticking to the leader at this point of time, Surbi.
Okay.
Because the earning traction.
So, Nikhil, we discussed
Please.
Yeah, go on, please, go on. You're explaining to us on the rationale behind the leader, preference for the leader.
Because they have already turned into black into the quick commerce segment, any incremental reduction in competitive intensity would lead to faster upgrade of earnings for the leader, and therefore my sense is the highest delta in terms of stock price appreciation could come over there.
Got it. Nikhil, so now I'm going to end, as we are coming to final thoughts, I'm going to end with one of the questions which is most hotly debated. And again, I'm talking from the perspective of anyone who is willing to put, let's say, fresh 100 rupees in the market. So there's this whole large cap versus small cap debate. And actually, large caps have they've just now started performing a little better with FPI flows turning positive. So how would you divide that 100 rupees? How much in large caps, how much in mid and small? And also in terms of themes and sectors, just help us out if you had that 100 rupee prototype to deploy in the market.
So probably I would say it should be 50, 30 and 20 is what I will use. 50 for large caps, because clearly valuations are on the favorable side for large caps, and the capital protection will be highest in case any adverse event pans out for that sector. And then 30 to mid caps and 20 to small caps is what the allocation should be. But what you have to also realize is in mid and small caps, it's very, very stock specific, because it's very difficult to generalize for the overall sector in that sense. You will have stocks and names in those space where even if the index doesn't do anything, individual stocks can move up by 20-30% based on their own earnings merit in that sense. So one has to be very, very bottom up when you are looking at, I would say, the small and mid cap space. However, having said that, some names do look interesting over there, and therefore, I would split 50-50 between large cap and the small and mid cap space in terms of allocation over there.
Okay. All right, Nikhil, great conversation. Thank you very much. Very detailed, of course, today. We had, a lot of thoughts, global and local, to go over. Appreciate you joining us today with your perspective. Have a good week and a good day.
Thanks, sir.